Hello, my name is Maria Bezubova and you're at my channel Fertilizers Jazz. Here we talk about events, trends, technologies in the world of fertilizers and agriculture. Please subscribe to the channel, put like to this video, and let's jazz! Today is August 11 and this is a weekly markets update. Let's have a look at the news of week 32 and see what are the next trends. Last week, global focus was on India, of course. The tender attracted 4.7 million tons of offers from all over the world, which is the largest figure for a couple of last years. As expected, Indian IPL, pushed by huge demand and deficit, was very quick in providing acceptances, and by today almost 2 million tons were confirmed for shipment. IPL extended tender closure to tomorrow, so maybe this figure will increase even more. The most unexpected move was done by China, where the government confirmed quotas for export to India to 9 companies for the total volume of 300,000 tons. It happened after China saw the extremely high L1 price and also followed Prime Minister Modi's visit to China. L1 price hit $530 CFR for West Coast and $532 CFR for the East Coast. This price elevated global level, of course. In the course of the week, sales supporting Indian tender were registered in the Middle East at $514 FOB, at $510 FOB in Southeast Asian producers, at $500 FOB for Nigeria, and almost the same for Egypt. China increased the export price for India to $490 FOB. Clearly, this level is unachievable anywhere except India, even if demand was there, which is not the case. What happens next? I am looking forward to the downward price correction that will happen in the second half of August. Supply tension eased, of course, with such significant amount of purchase. However, in September, it will be back. Egypt didn't have any production issues as we saw, and its domestic season will finish in August, meaning that as of September, Egypt will export full capacity. Some Southeast Asian producers, as well as Russian, will come back on stream after maintenance. And on the demand side, the picture still looks dull. Brazil is the only market which will need product in September, October, and affordability doesn't let importers to purchase at such high levels. Europe would also step in to make advanced purchases for the season ahead, but again, such high price will not stimulate to accumulate stocks. Other large consuming regions will be off-season, so supply pressure will increase. How much the correction will be is a million-dollar question. I believe that $30 to even $40 correction is very possible, and it will depend on the timing of the next Indian tender. If the next tender is announced to end September, it will help to keep the market from further price deterioration. But if India waits longer, which is very possible as well, market sentiment will become quite bearish. Let's first watch the final results of this tender. It will be definitely known later this week. Apart from the main news of the week, a sales tender was closed by a Libyan producer for 40,000 tons to be shipped during August in several lots at mid-450s FOB. In Iran, there were also a couple of tenders ongoing, but only a few were finalized with sales. Producers were targeting $430 FOB, while being not successful in selling $5 lower before the Indian tender. And then, on Saturday, the news appeared that new price level for this week was set at $440 FOB. So let's see if the uptick in the market related to the tender will help Iranian producers to reach such highs. I frankly don't think so, because their key markets, Brazil and Turkey, will not pay such price. Brazil is monitoring very nervously situation in the international market for sure. There were sales conducted in the range between $480 to $90 CFR last week, and clearly it is far from main suppliers' targets. Brazilian importers still try to offset highly priced urea with ammonium sulfate. Imports of AS surged by 16% this year versus 24%. However, as we discussed last week, further in September-October market will definitely need more urea, and the position of Brazilian importers will be the key driver for the global market. In the US, the key topic continues to be the tariffs. However, the main question about tariffs for Russian products is still on the stream, because diplomacy around Russia-Ukraine ceasefire deal was moving very quickly last week. And it is now very difficult to predict what happens even tomorrow. But the US market is anyway in off-season mode now, so let's see how President Trump's meeting with Putin, announced for August 15, will go. I don't think there is any sense to discuss any potential tariffs at Russia or secondary sanctions before that. Paper values cooled down almost to the level of 2 weeks ago, pre-Indian tender. Egypt FOB corrected by $10 for both September and October, to the average $480 and $475 respectively. Arab Gulf dropped also for August by $10, reaching average of $483, and decrease for October reached $15 from a week ago. US NOLA future values dropped even more by $20 for September and $15 for October. Brazil CFR also decreased to the average of $478 for September and $473 for October. For ammonium sulfate market, it was another slow week, with prices slipping on the contrary to urea. Chinese crystal copper product price dropped more because buyers decreased their bids in the course of the week, from $170 FOB to mid-60s and even lower. Granular price remained unchanged. Price rally in urea market had no impact at ammonium sulfate market at all. And still the demand was lackluster. Apart from Brazil, there is no activity elsewhere in the world, and Brazilian buyers already purchased a lot of products, so are not in a rush at all. Nitrates market continued to be very quiet last week. In Europe, there were almost no sales registered anywhere, and prices are just notion. In Brazil, an importer purchased 10,000 tons of Russian ammonium nitrate at $310 FOB Baltic, but the demand is limited there. In the US today, announcements regarding summer fill price for UAN are anticipated. Let's watch the situation, because UAN is the segment which is highly dependent on imports, and specifically imports from Russia, so any decisions regarding tariffs or sanctions will hit the segment the most. In the ammonia market, price west of Suez was stable last week, but supply remains very tight due to continuous outages in Algeria and some outages at Egypt. Spot cargoes availability will be an issue for August and September in the region. Last week, there were no fresh activity registered. Only in Turkey, there was a purchase done from Iran at price in 460 CFR, which is lower than previous numbers. Eurochem shipments from Ust-Luga resumed after the explosion of the vessel there. East of Suez, price firmed by $10, also due to supply tightness for spot deals, and despite Ma'aden is fully back on stream. Contract shipments are fully taking out all product available, and this seems to be the reason for price firming. However, there were no fresh spot deals registered last week. In phosphate segment, prices were stable last week, and it confirms that perhaps the ceiling has been reached. The main news of the week was Bangladesh tender for supply of DAP and TSP closure, where suppliers offered just slightly more volumes versus initial tender requirement. DAP prices were in the range between $874 to $950 CFR. Taking into account dedication of Bangladesh government to switch from NPS to DAP this year, most likely the ministry will confirm purchase of target volume. The tender tightened global supply even more, absorbing most of the volumes available from China as well as Russia. During the first half of this year, Bangladesh already imported 738,000 tons of DAP, very significant chunk of global pie. However, there were no fresh spot sales to India, and previously communicated ceiling of $810 CFR was not breached. The only deal that was registered is sales of 30,000 tons of Turkish DAP at estimated price of $807 CFR, but this is not confirmed. Though market is awaiting the outcome of the tender that closed on Friday for purchase of 50,000 tons of DAP. At the same time, FOB prices of Northern African producers inched up last week. Tunisian GCT sold 30,000 tons of DAP to Europe between 810 to 20 FOB, similar to the sales of Egyptian NCAC last week. However, demand is very weak in Europe for now, and poor harvest in certain areas significantly limits appetite for products stocking at such high price level. In Brazil, buyers continued resisting MAP price, which resulted in price decrease by $5 to the level of $750 to $55 CFR. High-priced MAP is actively replaced by other products this year. If MAP imports during the first 7 months of this year dropped by 8%, imports of SSP increased by 21%, imports of TSP by 42%, and imports of various NPS by incredible 61%. So all in all, country has imported enough phosphates, but not in the usual form. We will closely watch this trend if it becomes a new norm for the market or will be just a temporary solution for desperate times. In the US, activity in NOLA was almost non-existing after hectic sales of previous week. The only DAP sales registered happened at $805 FOB for September, which is $15 decrease versus highest sales a week ago. In general, US DAP MAP imports of the first half year of 25 dropped by 28%, which is a result of tariff-related uncertainty and low affordability. Moving to the fundamentals. European natural gas futures slipped more to 32.3 euros per megawatt hour as strong supply fundamentals helped offset broader geopolitical concerns. Gas storage across the continent continues to build steadily, supported by subdued demand from Asia, particularly China, and robust pipeline deliveries from Norway, which are running close to full capacity ahead of upcoming maintenance. LNG imports also remain solid, exceeding seasonal norms. Meanwhile, traders are closely watching geopolitical developments, particularly talks around a potential ceasefire in Ukraine. US natural gas futures hovered around $3 per MMBTU, supported by a decline in production, increased LNG export activity, and persistent heat across much of the country. Forecasts point to hotter than normal weather through late August, driving up gas use in power generation, which accounts for over 40% of US electricity. Also, daily output dropped to a 4-week low from the record high set in late July. Meanwhile, LNG feed gas demand has picked up following the return of Freeport LNG's Texas facility from outages and strong intake at Venture Global's Plaquemines plant in Louisiana. The big news of last week was the deal between Israel and Egypt for long-term gas supply. Israel has pulled off the largest deal in its history, 130 billion cubic meters from the Leviathan field to Egypt, worth $35 billion, running from year 26 to 40. Today, the flow is about 4.5 billion cubic meters a year. By the end of the decade, it will climb toward 12 billion. Taking into account that domestic gas fields in Egypt are depleting, the importance of this deal is difficult to overestimate. Let's hope that together with LNG solutions, it will provide sustainable gas supply to the country and also to fertilizer producers, of course. Agricultural commodities future prices were again in the red zone last week. Wheat futures dropped more to $5.15 per bushel due to an oversupply in the global market. Large harvests across the northern hemisphere have flooded the market with new crop wheat, weighing on prices. While lower prices have stimulated demand, reflected in stronger than expected US export sales, the overwhelming supply continues to dominate market sentiment. Russia, the world's largest wheat exporter, raised its 25 crop forecast to 84.5 million metric tons, heightening concerns over global surplus. Meanwhile, increased wheat planting and favorable early growing conditions in Argentina have added further to the abundant supply outlook. Corn futures fell toward $3.8 per bushel, their lowest level since late 2020, as US weather has remained ideal this season with timely rains and warm but not scorching temperatures across the Midwest, allowing corn to develop unimpeded. Traders now expect the USDA to raise its 25-26 yield forecast toward 186 bushels per acre, which would push US production close to 16 billion bushels and drive ending stocks above 4 billion. At the same time, export inspections have lagged year-ago levels amid fierce competition from Brazil and Ukraine, while domestic demand from ethanol plants and livestock feeders has failed to keep pace with surging supplies. Soybean futures dropped again at the end of the week to $9.67 per bushel, as supply outlook continues to weigh on prices despite short-term demand support. The decline followed a bounce in prices driven by higher-than-expected US export sales, which indicated that low prices were stimulating demand. However, expectations of ample supply and favorable growing conditions in the US have kept pressure on prices. Traders are closely watching the upcoming USDA report on August 12th for potential revisions to corn and soybean production estimates. The overall outlook suggests a bumper harvest later in the year, contributing to abundant supply concerns. Moving to the shipping industry. Containerized freight index dropped by 40 points last week. Trans-Pacific spot rates declined by 4 to 7%, depending on the route. Uncertainty related to trade with China continued weighing on the market. China to Europe rates also dropped by 4%. General expectation in the market is unchanged. Spot rates will continue declining in the course of next weeks. The Baltic Exchange Dry Index slightly recovered last week. The Capesize market showed a steady positive trend throughout most of the week. The Panamax market had a negative return. With limited activity emerging, the North Atlantic drifted further. Rates at East Coast South America receded throughout the week, and in Asia, rates overall were pegged down as demand, ex-Indonesia was mostly absorbed up by the smaller and older tonnage. In Ultra-Supramax segment, it was a very lackluster week. In the Handysize sector, the continent Mediterranean lacked much fresh impetus, while a little more activity was seen from the South Atlantic, and rates from here remained rather flat. Situation in Asia remained unchanged. To sum up, Indian tender received a record amount of offers, 2 million of which were already confirmed last week. The tender finalization is prolonged until tomorrow, so maybe the final volume will be even larger. Price also hit the record of $530 CFR to West Coast. High price stimulated China to participate in supply, which was the key news of last week, of course, but only with limited volume of 300,000 tons. What is next? Most likely market will see downward price correction in August, first half of September, and the scale of this correction will depend on the timing of next Indian tender and Brazilian demand. Both factors provoke high uncertainty because Indians now are quite comfortable to wait and catch lower prices for the next tender. And Brazilian farmers who are fighting affordability and credit issues are heavily relying on urea replacement by ammonium sulfate this year. So my guess is that we might see quite a bearish tone in the market during the upcoming month at least. Ammonium sulfate price hasn't shown any reaction at rally in urea, mostly due to limited demand from Brazil. Ammonia price was stable to increasing both west and east of Suez due to tight spot availability. Phosphates prices stabilized indeed amid limited demand from India, which covered its immediate needs by massive purchases of previous weeks and lackluster demand from elsewhere. The only other factor fueling price level is demand from Ethiopia, where EIBC is finalizing its huge phosphates tender. Additional supply from China is still unconfirmed, so market kind of froze in this situation when affordability limits any further upward price moves. Natural gas price, both in Europe and the US, decreased a bit based on healthy supply and rather mild summer temperatures. Prices of all key agricultural commodities dropped again, and the mood in the market is gloomy. Abundant supply from the vast majority of producing regions is weighing more and more on market prices. Container shipping rates decreased more last week, following the tendency of past few months. Bulk shipping activity picked up, mostly due to positive developments in Capesize segment. So let's see what is next around the corner, but it will be already next week. Thank you for watching. Please subscribe to the channel, put like to this video, push the bell in order not to miss any updates, and see you soon.